I'm Larry Walther. This is principlesofaccounting.com, Chapter 12, and in this module we will look at the accounting for contingent liabilities. Contingent liabilities are those obligations that are uncertain or potential. They may give rise to actual liabilities, or they may not, and the timing and amounts are uncertain. Examples include legal disputes, environmental contamination problems, product warranties, other firm-specific risks perhaps. They're different from general business risks, such as the risk of war, storms, where no specific accounting is made in advance. We have some criteria-driven outcomes here. First of all, if the liability, the contingency becoming an actual liability is probable and subject to reasonable estimation, then we record the liability in the financial statement. However, if it's only reasonably possible that we'll have an unfavorable outcome, we generally only footnote the existence of the contingency. And for contingencies where an unfavorable outcome is viewed as being remote, no disclosure is required. So, continuing, we record a contingent liability in the accounts if it is probable that the future event will occur and the amount can be reasonably estimated. In that case, a loss is recorded or debit to a loss, and a liability is established or credit a liability. If the estimated loss can only be defined as a range of outcomes, we can't identify a specific point estimate, then under USA GAAP we generally record only the low end of the estimated liability. The midpoint is used for international accounting standards. There's an interesting history and logic behind these particular ideas about what amount should be recorded, but it's certainly not the most conservative approach to record the lower end of the range. It's simply the approach that's stipulated under GAAP. So one needs to be very careful when they look at contingent liabilities and their calculation and presentation in the financial statements, because the firm risk can actually run much higher than that. If it's only reasonably possible that the contingent liability will become a real liability, a note to the financial statements is appropriate. A similar treatment is afforded when it is probable a loss has occurred and the loss cannot even be estimated. Normally accounting tends to be conservative, but that's certainly not the case with contingent liabilities. Remote risks do not need to be disclosed. They're viewed as needless clutter, distractions, for example, a frivolous lawsuit where there's almost no chance of an unfavorable outcome. Disclosures of business decision risks are not required, but neither are they discouraged. For example, a company may decide to reduce their insurance coverage to save money, to avoid a high premium. Well, that exposes the company to certain risks, but it was a business decision that was made, and as I say, that's not required to be disclosed, but neither is it discouraged. Contingent assets or contingent gains are almost never recognized in the financial statements, at least never until the payment or the benefit of that is actually received. For example, a company's claim against another company for a patent infringement, while it could be significant and material, we ordinarily would not report that as a benefit or an asset. The timing of the events also needs to be considered. For example, if a customer was injured by a defective product in year one, but we did not even learn about the injury until year two, the question is, should we go back, assuming year one financial statements have not been issued, and adjust them for the event that we did not even know about in year one? The answer in that case is yes, because the event giving rise to the loss occurred in year one, we should adjust year one financial statements for that amount. If we flip this around, the injury occurred in year two, even though it might be very material and adverse, year one's financial statements are not affected because the event giving rise to the loss did not occur until year two. We might have a note to the financial statements saying, hey, subsequent to year end, this issue arose and we'll have this potential future cost associated with it, but we would not adjust the financial statements. Let's think about a specific case such as a warranty liability, which you might view as an estimated liability or a contingent liability. When goods are sold, an estimated amount of the warranty cost to be incurred on the goods should be recorded as an expense with an offsetting credit to a warranty liability account. As the warranty work is performed, we're going to be crediting cash and debiting the warranty liability account. This follows the matching principle such that we're recording expenses in the period of sale. The actual work may be done in a subsequent year. Here's an example. Zeph Company had a beginning of the year warranty liability account balance of $25,000. During the year, Zeph sold $3,500,000 of goods and estimated that we would incur warranty cost equal to 2% of sales. It's just an estimate, but we actually did $80,000 of warranty work during the year. Let's look at a T account to analyze the effect of what's occurred for Zeph. First of all, there's the $25,000 beginning balance in the warranty liability account. We did sales of $3,500,000 and we provided 2% of sales, or $70,000, as an additional accrual. So we have $95,000 in credits. As we did the work, credit cash to pay vendors and so forth for parts or whatever for the warranty work. We're going to offset that by debiting the warranty liability, $80,000, and that'll give rise to a $15,000 ending balance for the estimated remaining liability at the end of the period. Here's the journal entries. There's the sales, debit cash, credit sales, $3,500,000. Simultaneous with recording the sales, we'll debit warranty expense and credit warranty liability. That's 2% of sales. And as the work is done throughout the period, we'll credit cash and debit the warranty liability amount. There are other costs that are similar to warranties. These would include coupons, prizes, rebates, airlines with their Advantage Miles programs and so forth, free hotel stays, free rentals, other items associated with sales activities. All of these represent items that are deemed to be probable and subject to reasonable estimations. They're estimated liabilities that broadly fall under the umbrella of contingent liabilities susceptible to accrual.